All right, good morning. I know we're running extremely late here, and I apologize. We had all kinds of trouble with Zoom. Apparently, Zoom has made some updates, and we weren't made aware of it. And unfortunately, we have lost about 45 minutes of the class session. I don't think I've ever seen this kind of a delay in the class all the years I've been teaching, but we had to bring the AV guy over in order to sort of fix this, and hopefully they're getting this. What I'm going to do, I'll come back later in the day. I'll record the second piece of this, but I do want to get a little bit deeper into chapter 2 today and talk about what's going on. And by the way, I revised the due date for the material for chapter 2 to next weekend, not this weekend. And because, there are a little bit of, this is my mistakes, nobody's fault but mine on the chapter 1 quiz. I moved that back to this Friday, as the due date, but I've deferred everything else. And as I mentioned on Tuesday, we're going to defer chapter 2, 3, 2, 3, and 4 a week. I've already made the change in both Brightspace and Connect for chapter 2. I'll do the rest of it later, but that's essentially what's going on here. But I've never seen anything like it where we have had these kind of issues. But we'll have to. What is going to mean is I'm going to have 2 different videos for this particular class session. I apologize for that. I did not see it coming. I never seen it happen before, and apparently Zoom made some changes and didn't inform the rest of us, and so as a result, we were getting some weird visuals on the screen. It took a while to get resolved, but I will come back, and I do want to get through what I wanted to cover today so that we can stay on track. And there's a lot to do in this course, and so I really don't think we can afford to lose a lot of time, and so that's why it's especially irritating. But anyway, things are out of my control, and I'll try to make up for it as well as I can. All right. So I think we have, amazingly, we have people on the Zoom call still, it looks like. And also, the other thing, too, is that the original Zoom link, I think, is not correct, because that all changed and defaulted to a different time, which I've never seen happen before as well, where usually at the beginning of the semester, I say, all right, every Tuesday, Thursday, 10:30 to 11:45, we're going to have this Zoom session. It's going to be the same link, and you can copy the link and have it saved and whatnot, but the link is probably going to change now because for whatever reason that changed. And so Zoom is kind of, I'm not a fan of them right now, so just kind of bear with me and look for 2 videos regarding this class session. And if you have questions about any of the upcoming activities, let me know. I'm more than glad to go over with you, or any problems you may have or whatnot. So, all right. Okay, so we're talking about, in chapter 2, we're talking about essentially recording transactions, and really going over sort of a view from 30,000 feet as to what we're doing with recording transactions, compiling those, doing trial balances, which are a lot easier now in the current environment than what they were back in the day. And then eventually preparing financial statements, which is really the end goal of financial accounting, is to prepare statements so that external users can get an assessment of how the enterprise is doing. So in this case, we have a series of transactions, and I wanted to sort of walk through these because some of these are going to be particularly relevant as we get going, because they're pretty generic transactions for the most part. They're going to sort of mirror a lot of what you're going to see in the chapter 2 homework and quiz. So transaction 1 is an attorney invested $50,000 to open a law office. So in other words, he directed cash, so $50,000, he or she, whatever, and shareholders' equity is going to go up. So this is treating this on the left side here from the accounting equation standpoint. That is the original view that we sort of presented back in 2110 for those of you who took it here, and that is the idea that both sides go up by 50,000. Okay. When it comes to the T accounts, which are sort of just a gadget, I would say, $50,000 debit, $50,000 shareholders' equity. These are left side, right side, left side, right side, and as a result, cash goes about 50,000. It's a debit. Shareholders' equity goes about 50,000. That's a credit. They both balance. Pretty easy transaction. Nothing too complicated there. Okay. And by the way, not every event or transaction is going to involve one debit and one credit. Sometimes it's going to be multiple debits, multiple credits. And depending on the complexity of the transaction. So, but nonetheless, the basic rules apply about the balance of debits and credits, and that's sort of a feature of the dual entry system. Transaction 2, $40,000 is borrowed from a bank, and a note payable was signed. So as a result, liabilities go by 40,000, assets go by 40,000. Both sides go by the same amount. The cash enters the cash account, which is going to be a debit, and notes payable, which is a liability. And so as a result, debits and credits equal each other there. Okay, pretty straightforward transaction. Nothing too tricky about it. One of the things about notes payable, I'll say, and I've talked a lot about the notes to financial statements, is that accountants will record in the notes usually what the terms of the transaction are. What's the term of the liability? In this case, it looks like a bank note. Yeah, it's a bank note. Interest rate, usually term, what are the repayment terms? Sometimes they'll get into issues concerning collateral, etc. But those are usually disclosed, even in the most basic of the financial statement presentations, which we call a compilation. A lot of times CPAs will get into disclosing what those details are. All right, transaction 3. And all we're doing is sort of walking through a series of transactions, which is a lot of what we do in intermediate accounting. A lot of it's simply applying techniques and sometimes different methods and whatnot. So some of these are relatively straightforward. In this case, supplies costing $3,000 were purchased on account. So supplies, which is an asset account, goes up, liabilities go up, and so supplies account. If you create an asset account for supplies, will be $3,000. And it's not been paid for yet, so as a result, accounts payable $3,000. Okay, the debits and credits equal each other. And again, I talked a bit, I think, about on Tuesday about the idea that sometimes supplies are such a small portion of total cost of an enterprise, particularly service organizations, that sometimes there's not really even a bother to to record the asset, because somebody's going to go back and adjust it at some point. And do you want to go do that? Obviously, manufacturing supplies are a bigger issue and whatnot. And sometimes they work their way into inventory, which itself becomes a different problem altogether. Okay. Transaction 4, services were performed on account for $10,000. Okay. Well, so remember, embedded within shareholders' equity is the income statement itself. We got revenues and expenses. Okay. Revenues are obviously an increase in shareholders' equity. Expenses are a decrease, and so you get these two vectors pushing against each other. In this case, you're selling something, services, and there's no inventory involved. That's the beauty of the service industry, is there's no inventory, which is why a lot of us like the service industry better, probably. And so assets go up, and on accounts are receivable, and so over here it's noted what it's a debit account receivable, and shareholders' equity goes up. Now remember, we haven't collected receivable yet, but in accrual accounting, we are not concerned with that. And if there is concern that this or any other particular receivable is not going to be collectible, we have ways of dealing with that. And presumably, if you know at the outset it's not going to be collectible, you probably wouldn't do the sale in the first place. But at some point down the road, because sometimes these accounts get quite aged, and it becomes clear that the entirety of it's not going to be collected, or maybe none of it's going to be collected. But from a broader enterprise standpoint, we have ways of dealing with that, usually dealing with the allowance method, that is saying, based upon our experience, yada, yada, this is what we expect to collect versus what we expect not to collect. And so as a result, we can create an expense for that, an allowance. And we simply deduct it from the accounts receivable account. It's basically a contra asset, okay? And we'll get to that a bit later. All right, we'll come to that issue later. Transaction 5, salaries of $5,000 were paid to employees. These are almost always created as an expense right away, except for the fact if we cross an accounting period where there are wages payable, then we have a liability. But within an accounting period itself, employees are going to be paid in cash, obviously, and it's going to result in a reduction in cash and a creation of expense. An expense that is always going to be a debit balance item coming out of shareholders' equity. There's probably going to be an actual account called salaries or wages expense, whatever the case might be, right? And salaries and wages are a little bit different in terms of the identification of who's who in terms of exempt versus non-exempt. That's not so much our concern here. The idea is that an expense is going to be a debit to offset the credit to cash. And one of the things that we talk about in 2110 and even in the beginning stages of 2120 is this idea of the criticality of paying salaries and wages. Workers obviously can't work on credit and can't take even a day's delay in receiving payroll. And so as a result, firms go to great lengths to make sure that these expenses are paid on time and in full, as well as benefits and taxes and all the other things that are a feature of that. Okay, that's transaction 5. Transaction 6, we used up $500 of supplies. So assuming we did capitalize supplies as an asset, we have to adjust it down. Somebody is going to go back and say, we used $500 up, so we're going to reduce the asset account and we're going to create an expense for supplies expense. Okay, which again, so expenses are always a reduction, inherently a reduction in shareholders' equity. So that transaction balances. At some point, we're going to go back and do that if we want to sort of do that. Okay, and then for the final transaction, this particular series is $1,000 that was paid on an account to the supplies vendor. So we had a payable at some point, and I'm trying to see which transaction it was. There it is, right? Number 3, where we purchased 3,000 and we ended up paying 1,000. So what do we have? We're going to reduce assets, obviously cash in this case by 1,000, and we're going to reduce accounts payable by 1,000. It doesn't zero out accounts payable because we still have this amount outstanding, or plus other amounts, but this transaction will balance. So and it balances in both cases, and this is what really is interesting about the Spiceland text, which we're using, is that we present both views, frameworks for how we view accounting transactions. In this case, the accounting equation, both sides go down by 1,000, and also in the debit credit methodology, which we're going to rapidly move into. And in this course, one debit, one credit, and they both equal each other. Again, some events or transactions do not involve only one debit, only one credit, but the key reality is they've got to balance. And if they don't balance, we've got something of a problem. And so that's what's going on there. So any questions about those transactions and the posting of these? Okay. And when we talk about the posting, we'll talk a bit more about journalizing these transactions, that is, recording debits and credits, and they're presented in a chronological sort of fashion. And then from there, we move over to posting to the general ledger. And the general ledger is probably best thought of as just a collection of all accounts, assets, liabilities, revenues, expenses, equity accounts that are a feature of any enterprise's accounting system. And so that's really what the GL is. And for those of you who've worked in environments in which we're debiting and crediting the GL, that's what we're really doing, is we're raising and lowering amounts based upon what it is we're trying to do. Okay. All right. So we've recorded these transactions. The question is now, what do we do with these? So step 3 is recording transactions in a journal. I know that we started chapter 2 a bit on Tuesday, so we're sort of cutting things off just because we have a limited amount of time, and I really do apologize for having to sort of split this up, because I did want to get through the bulk of chapter 2 today, and I'll come back later, probably this evening after everyone's gone, and I'll record the rest of this. But journalizing the transactions is something that is important, and it's often used as sort of a reference point to say, hey, what happened when and where. And a lot of journal entries will have some notes that say what it was all about, usually referencing things like invoice numbers or whatever, whether it's a company we issue the invoice or somebody else issued the invoice to us, but it provides a record in order of what happened, right? And they're expressed in terms of debits and credits. And all they really are is simply a presentation of what the event is. And I say event more than I do transactions, because all transactions are subsets of events, because there are some events that are not transactions at all. Things like adjusting entries. Well, there's no transaction that says that we have to adjust appreciation or adjust accrued interest or whatnot. There's no transaction, but it is an event, and all these have to be recorded and journalized. And we'll get to this idea of adjusting entries a bit later, because it is a process that is necessary in order to get to closing the books, primarily income statement accounts, in order to go forward and closing one year and going forward. Okay. When we talk about special, well, all right, let's start with general journal first. General journals are any transactions and it's not recorded in a special journal. And so that's kind of a weird definition, but what it really says is that these are transactions that don't belong to these special journals. When we talk about special journals, there are dedicated journals that are they're really designated for certain transactions: cash in, cash out. In other words, receipts and expenditures, purchases. If it's a periodic inventory system where we are not booking purchases of inventory into inventory, we're just simply booking the purchases, and then we'll deal with it later. And there are some disadvantages of that particular system, but it serves some companies usefully in that regard. So those are special journals. And it could be, and a lot of times special journals are unique to the particular industry in which one is operating. And, and like, which we could say about a lot of accounting applications, is the idea sometimes they're really unique and specific to what is going on. So special journals are only those that are dedicated. So here's an example of a journal entry, and we went over this a little bit on Tuesday, and it's part and parcel of what we do. I know it was gone over in Accounting 1135, which is a prereq for this course. And it's the idea that we talk about every entry has to be expressed in terms of equal debits and credits. Doesn't mean one debit, one credit. It can mean whatever. Maybe two debits and one credit. It doesn't matter. And they are in dollar figures. We have the monetary unit concept applies. So in this case, back to our concept, or back to our transaction where $40,000 was borrowed by a bank by signing a note payable, and so as a result, $40,000 goes to cash, and notes payable was about $40,000. If you were just to sort of flip back a little bit, you would know that cash is on the left side of the accounting equation. That goes up by 40,000. Notes payables on the right side. That goes up by 40,000. But here, and to close the loop, debits and credits equal each other, okay? And these are going to stay there until something happens with regard to this particular transaction, including things like accrued interest on that note. The note will be paid off at some point, hopefully, and whatnot. So things are going to happen over time to deal with that, okay? All right, so we got about 15 minutes, and I wish we had more time, but I think we can get through, in this particular segment, these. They're about, how many transactions are there? There are a number of them, and we're going to see what they look like in terms of the journalization, and then we're going to prepare statements based upon these. So this is a really good simulation, I think, as to some of the events that are happening in a very limited time frame and whatnot. So let's kind of do this. Let's kind of walk through these and talk about how they reflect in terms of the accounting treatment, okay, which is the term of art that we're using here. So in the first transaction, let's go back here to July 1st. Two individuals each invested $30,000 in the corporation. That's $60,000 total, $30,000 times two. And each investor was issued 3,000 shares of common stock. Now, the shares of common stock, we don't really care about. That's not really what we're concerned with in recording, in terms of recording the journal entry. It is obviously of importance, clearly, and you would probably disclose that in the notes. But the basic transaction is this: the company received $60,000. Now, the company is a separate entity from the individuals. Remember, corporations have a separate legal identity from their owners or from anyone else, for that matter. And so, as a result, the cash that goes to the company is the company's own cash, $60,000. And we're going to create a credit for the common stock transaction. Remember, this is one of the equity accounts, right side balance. Typically, common stock usually goes up in value. Yes, we'll talk about treasury stock a bit later, but that's not what's going on here. We're talking about initial investment. Looks like an initial investment in the company. And so as a result, cash goes up, common stock goes up. And by the way, and I say initial investment, I don't even know that I can make that assumption, because a lot of companies will issue new stock, and even very old companies. And so people will invest in that. Well, a very, very similar transaction. Second transaction, I'm going to kind of be flipping back here to these reference points. July 1st, borrowed $40,000 from a bank and signed two notes. The first note for $10,000 requires payment of principal and interest. Okay, we don't care about that. Second note for $30,000. We noticed no $40,000 is going to be borrowed. Now we will break out let me see here. we'll probably break out the issue. And by the way, there's an error here. There's an error. There's a question of an error. This should be notes payable. This should be not common stock notes payable. So this is a mistake, and you know it happens. There's no question. This should not be common stock. This is not an equity issue. This is an acquisition of debt. So it should be notes payable. And what I would do if I were recording this, I would say $40,000 cash, and I would do two entries for the credit side. First for 10,000, the other for 30,000, because there are two separate notes. I would do that and they may amortize at different, terms over time, and we may pay one off earlier and then the other. I don't think we want to combine these. But notes payable, and when we report on a financial statement, they're going to sort of be combined together. But I think the initial entry would be one that we want to split up, and we would disclose in the notes what these terms of the transaction are, including rate and term. Those are important issues that we want to disclose. But that is definitely an error. This is not a common stock credit. It is a notes payable credit. Absolutely no question about that. Okay. The next transaction, and I'm just going to flip it back here, was okay. We paid $2,400 or $24,000 in advance for 1 year's rent on the store building. All right. So this is a prepaid, what we call a deferral, and that is the idea we're paying ahead of time for something. Now, there are a lot of deferrals in accounting. We'll talk about deferrals and accruals. These are things that were covered in introductory financial accounting. But deferrals are these things where we're not deferring the payment, we're deferring the activity. Follow the activity, not follow the money, is what we usually say in financial accounting. So we've all probably heard the term follow the money. Well, don't follow the money, follow the activity. We're paying ahead $24,000 and we're expending cash, which is a reduction in cash. It's credit to an asset account, and we're prepaying rent. It's basically one asset being converted to another asset, okay? And we're paying in advance. I don't know how common it is to pay for 1 year's rent on a building. I suppose it depends on the terms of the lease, but if there is a prepaid item like this, then it would certainly be capitalized as an asset. Now, here's the thing about prepaids. The classic example of a prepaid is insurance, which I can't think of any other product or service that more represents a prepaid than insurance. And the insurance industry collects money up front just due to the nature of the business. That is, hey, we're going to prepay for, I don't know, car insurance for a year ahead of time, right? Or 6 months. And they're not going to come out after 6 months and say, okay, pay for that 6 months that you did not use our product and whatnot. So it's just the nature of the particular business. And so insurance is obviously a biggie. And every firm has some sort of insurance on something, whether it's property or whatever. I mean, but that's a classic example of a prepaid item just due to the nature of that transaction. Next transaction, we record the asset purchase in the journal. We bought office equipment for cash, so we're going to debit office equipment, credit cash. Okay, easy peasy, no problem there. Again, it's an exchange of one asset for the other, so both sides balance each other. And by the way, this does not affect the accounting equation, because all we're doing is the $12,000 increase in one asset is offset by the $12,000 decrease in another asset, cash in this case. So there's no effect on the accounting transaction. So the two methodologies are not in opposition to one another at all. They're in sync. But what we're trying to move into is this idea in intermediate accounting, which we began in accounting applications, of being able to think about how we record transactions in terms of debits and credits and that sort of methodology there. Okay. All right. Let's move on here. Next transaction was we bought some inventory for $60,000. And so we have inventory, which is one asset. So the asset side goes up by $60,000. The right side also goes up by $60,000 in the accounting equation, or the tabular summary, which was called in the old textbook. And so both sides go up. And so as a result, we have inventory, which is debit, accounts payable, which is a credit. And this is assuming that we're talking about what we call a perpetual inventory system. Now, I wanted to sort of stop a little bit here because I think that it's been a while since you took introductory accounting. We've got different ways, well, two broad means by which we record inventory. And there's what's called a periodic system, where we simply buy inventory and we put it into a purchases journal. We just basically book it into we journalize it and put it into purchases. And then at the end of an accounting period, whatever that is, we determine what, cost of goods sold were, right? That's a really inadequate way of doing it. And for any company that's got any amount of inventory, the perpetual system is one in which we book inventory, we book purchases directly into inventory, and we cut out that process of the purchases journal, and so it goes straight into inventory. And that's definitely an advantage because it gives you a more or less real-time view of what inventory is. Now, obviously, inventory has got problems after problems after problems. Among these, and the thing that we're seeing a lot of, particularly in the business press, is the idea of shrinkage. And shrinkage is what? What is shrinkage? Uh, it's the reduction in inventory due to theft and loss and damage and whatnot. And I think Target reported not the most recent quarterly report, but they talked about how they're losing a lot of inventory due to shoplifting, and so it seems to be an epidemic right now. And so even if we do say we have 60,000 inventory, who knows how much of that's going to disappear before we know that it's disappeared, and that is a real problem, which is why we still have to take inventory and engage in all these other internal controls and whatnot. But it does have advantages over the periodic system in the sense that we can control or at least have an idea and make allowance for these shrinkage items as to what we have in inventory at any one time. And by the way, these systems that account for inventory in a perpetual system have been around for a very long time. I was a college student back in the early 80s, and I worked at a Target. I bring up Target, I just, not because I worked there, I worked there for 2 years. It's not like I'm a part of the company, but they had a deal where the phone lines went down one day, and the managers were kind of scrambling around. I didn't know why they were so perturbed, but apparently the system, this is well before the internet, every time you bought a bottle of shampoo or a lawnmower or whatever, would take it out of inventory right away. It would go over the phone lines. And so these are systems that really predate the internet, and they've been around for a very long time. But they do allow for better inventory control. And there are some companies that are very, very strong in inventory control. And among those were Walmart. Walmart is a very, very strong, manager of inventory. They know pretty much where things are, even if they're on a truck moving somewhere. So inventory control is a big issue, but I bring it up only because this is the transaction itself. Okay, and because the fact that it's booked in inventory and not purchases suggests that it's a perpetual inventory system. Perpetual in the sense that it updates itself on a more or less continuous basis. And by the way, managers, anymore like to come in, top managers like to come in the morning and pull up what we call these dashboard reports that show what happened yesterday and what happened all week, what happened all month, whatever, so they can know what's happening, right? And next transaction, purchase of supplies in a journal. So supplies are booked into as an asset and cash expended, easy transaction. They're one asset for another, and we're buying supplies, okay? And I can't recall if we pay this payable late or no, it's not a payable. We pay cash, so it's so that transaction is done. All right, so here we get into this idea. We're using a perpetual inventory system approach in this case, and what happens when we sell something? So we sold a merchandise that was worth $20,000, and so we're going to book it into cost of goods sold. Now remember, one of the things about inventory, which is it's kind of a unique asset in a lot of ways. We don't ever record the expense of inventory, including all the expenses that are incurred in bringing that good to the market, even if it's labor and shipping and all that we incur. We don't hit we don't have the income statement until the goods sold. And so cost of goods sold is recognized at the time it's sold, and we take it out of inventory. And we have the cash received. This was sold for cash, not a receivable. But if it were receivable, it would still be roughly the same, except there's no cash and sales revenue. So this balances. And so what do we have going on? We have $15,000 profit, gross profit on this particular transaction, right? That's just an easy look here as to what's going on, right? So cash, sales revenue, okay? Now this is very common, this particular setup here, and we got into a little bit of this in 2110 where we said, okay, if you sell inventory and we're using a perpetual system, we got to take it out of inventory at the time we sell it, otherwise it wouldn't be perpetual. So that we have credit inventory, crediting an asset brings that asset down, recording an expense is a debit balance affair, and then we have the cash received, or what could be receivables, but in this case it's cash and sales revenue, okay? And that's essentially a very, very common representation of what's going on with this. If we can identify what the the cost of goods sold are, and that's in itself a subject for another day. But that's what's going on with that. I do want to kind of wrap it up here because we have another class coming in, and I will record the rest of this a bit later today. And look for that maybe tomorrow because it does take a little bit of time to process this, both on our end and also on YouTube, because they do a check to make sure I'm not doing something grotesque. And so in this case, we sold clothing on account of Briarfield School for Girls. That's the account. And by the way, this client would probably have a client ID number that we would probably assign in our accounting software, right? Whatever the 123, whatever it is, right? And the clothing costs $2,000, same transaction. The only difference here is that we're booking a receivable and we sold two of them on credit, and we don't know what the credit terms are. It doesn't matter. It matters, but it's not what we're concerned with here. We debit receivables, credit sales revenue. And by the way, sales revenue, there are all kinds of different terms for sales revenue. It could be sales, just sales. It could be revenue, just the term revenue. It could be service revenue. It could be whatever. But they're all really essentially the same thing. Inflows of assets. In this case, the inflow of the asset is a receivable that offsets the sale of the good. And the good we sold was actually of physical nature. And inventory does have a physical nature typically. And as a result, we're going to record the cost of those goods, and we're going to reduce inventory by that amount. Okay, and that's the transaction that's going to be posted for this particular transaction. Okay, and I don't think we're going to get through all this here, but I do want one more thing, and then when we come back on Tuesday, well, actually not come back on Tuesday, it'll be later, is I'll talk about what we do at those events, which I think mostly what we call external transactions, and how we put them together and create a financial statement. So once again, I just want to cover real briefly the differences between a perpetual and periodic inventory system. Periodic inventory system was, really sort of the original system where, and today we look at it sort of and being very much outdated, but it's probably still used in some particular cases. And by the way, there are still companies that do use what we call the specific identification method, where you've got very unique items, very few items in inventory, maybe jewelry, and even if you have 400 items of jewelry, those are all specifically identified. And they may be a little bit more applicable to the periodic inventory system, but I would argue the perpetual system is far and away. I don't think when I say I would argue, I don't think there's a lot of debate about it. Everything updates continually, and so we get good information. And remember, yes, the purpose of financial accounting is to provide information for outside users, but it also provides information to managers as to what's going on. And in fact, that source data that becomes available to external users is internally generated in the first place. We're a publicly traded corporation. We'll have auditors confirm all this, but that they're internally generated information. Okay? All right, so I think we're out of time here. I'm going to stop. I'll come back and do part two a bit later. Any questions before I sort of terminate this particular discussion? Okay, I will see everybody on Tuesday. And if you have questions about anything regarding Chapter 2 or anything else, again, that's been deferred till next week. So, but if you have difficulties with Chapter 1's quiz, you still got some time to work on it, and feel free to get with me if you have questions. Have a great weekend. See you next time.